Okay, we have one last concept to cover, and then we'll move on to more of the exercise side. The time period concept here. The time period concept guides owners to the corporation to periodically give out financial statements. So the accounting period concept gives you the idea of an annual period, what would be the cutoff point. The time period concept here guides corporations to give out these statements on certain intervals. So remember that it's required for them to give it out financial statements on a quarterly basis, annual basis. They can also decide whether or not to give out monthly statement, but it at least has to be annually and quarterly statement. With all these statements, it updates the accounts to a certain period of time. So if the monthly statement is from January 1st to January 31st, then you will be seeing all the accounts that are being brought up to date to January 31st. It should be the information that relates to that date. Up to that date, what's the cash amount that the company has on hand? Up to that date, what is the accounts receivable? What is the cash that the company expects to collect from customer later on? Or accounts payable? Or what is the current retained earnings amount? Okay, so the information will be, all the different accounts should be brought up to date after recording these transactions, posting to ledger, and adjusting them. Then the company gives out financial statements. So this refers to different intervals of financial statements. Okay, now here's an example of adjusting entries before we actually go into different types of adjusting entries. This is a salary expense type. Okay, so for this transaction here, let's say earlier that the company hired a person to start work for the business starting from May 1st, the beginning of this month. Let's say the salary, the paycheck is given bi-weekly. May 15th, there's 2 weeks of work of check will be given out to this personnel. And then June 1st, another check, bi-weekly check will be given out. So if the company wants to do a monthly statement at the end of May 31st, since the pay date is June 1st, for example, the pay date is June 1st, when it reaches May 31st, the company would have to record the transaction that relates to this person working in your business, but you have not yet paid their salary. Okay, so this is what this transaction means. Last paycheck was paid May 15th. Next one would be June 1st. So in the middle of these 2 weeks, we have this employee still working for the company for 2 weeks, for 10 days, and let's say the salary altogether is $900. So in this case, when it reaches May 31st, because the monthly statement only captures the transactions from May 1st to May 31st, we will not be capturing salary expense that we are paying off June 1st. Okay, it only ends May 31st. So this will be an example of a transaction that we record the salary expense that the company incurs starting from May 16th all the way to May 31st, the 2 weeks. So this will be recorded as an adjusting entry like this. Debit salary expense, credit salary payable. And the reason why it's payable is because it's not yet June 1st, but we have to do a monthly statement that ends May 31st. So this financial statement will only cover any transaction that falls under May 1st to May 31st. This is still considered a liability for this corporation. Okay, so this is an example of adjusting entry. Because earlier when you paid off the check, that definitely will be recorded as salary expense and credit cash. But that transaction already has been done in the middle of May. When it reaches May 31st, if we don't record this transaction, then it seems like we don't have an employee that has been working for us between May 16th all the way to May 31st. So without this transaction, salary expense will be understated. So without this transaction, then later on the information you see under financial statements, net income will be overstated. Okay, the reason why, again, we're capturing this transaction goes back to matching principle. If this person has worked for us within a certain period of time, we capture their work. This expense has already incurred, even though we haven't paid the check. The employee has been working for our corporation for 10 days, for 2 weeks. Okay, so this $900 is not yet a cash payment, but is considered a liability that corporation owed to employees. Right, so this is the idea of one type of adjusting entry. we adjust the payable, we adjust salary expense before the monthly statement is being given out. So the right-hand side salary payable, without this entry, then the total liabilities would also be understated. Okay, so this is an example of adjusting entries. Before monthly statement is given out, we need to bring up some of the accounts to its current status, to its current value, based on matching principle and revenue recognition principle.